Hi, so let me introduce you to the concept of what an accounting cycle is. Accounting cycle is a life cycle of a transaction. A transaction is any event in a business which is like sales, purchase, buying an asset, or paying off a liability. So first of all, we record a transactions in our subsidiary book. Book is the relevant book that if we pay off something, then suppose if we purchase some goods, then we have to record it in the purchase books, that is called subsidiary book, and we record it by journalizing the book. Okay, and then we create a ledger by that, and then we move on to a trial balance by all those ledgers, and then there are adjustment entries of all the journal entries that were created if there is any adjustment, and then there is a trial balance adjustment, which is adjustment into the previous trial balance prepared, and then we close all the nominal accounts. I'll introduce you to the concept of nominal accounts later, but for just now, remember that all the accounts that are nominal are closed at the end of the year before making the financial statements. So that is how we come to a true presentation of a financial statement. So this is a journey of every transaction, and we'll go by this journey only. Now let me introduce you to the most important concept of a balance sheet, which is accounting equation, and we'll learn how a balance sheet is always balanced. So this right here is an accounting equation which tells us asset equal to liability plus equity. So you can see right here, asset is equal to liability plus capital slash equity or owner's fund. Asset is anything we own, and liability is anything we have to pay back, and equity is the owner's capital or is the shareholders fund, or is the cash or goods introduced by a owner in the business. Let me tell you this with the help of a balance sheet. So this right here is a balance sheet, and as you can see, this side is an asset side and this side is a liability or stockholders equity side. So whenever asset sides increase, liability sides also increase. Whenever an asset side decreases, liability sides also decreases. That is why this will always be balanced. Like 1,01,000 is equal to 1,01,000. As you can see right here, I have with me the balance sheet of Facebook Incorporations, and this here is the asset side. The total assets are, I'll name them as A, is 97,334, and this here is the liability and equity side. The total liability is 13,207. I'll name it as B, and the total stockholders equity is 84,127. I'll name it as C. So the total of B plus C comes to 97,334, and as you can see, A equal to B plus C, 97,334. That is how a accounting equation goes, and that is why a balance sheet is always balanced. Now, why does this magic of balancing happens? So this happens because of the double entry accounting system that we follow. A double entry accounting system requires the use of two or more accounts for each transactions. So as you can see right here, this is an accounting equation. Asset equals to liability plus net worth or owner's fund or equity. Hence, whenever a asset side is increased, corresponding liability side is also increased, and whenever a asset side is decreased, corresponding liability side is also decreased, hence vice versa. So it is like a seesaw. If the asset side increase, the liability side should also increase, and if it is not balanced, this is a wrong statement, and if it is a balance, it is a correct statement. Let's check out this example which says right here, a business starts with an investment of $75,000. So cash of rupees 75,000 is bought inside the business, hence cash, that is asset, is increased, and correspondingly net worth, capital, which is owner's capital or equity, or owner's fund is also increased right here. Hence 75 equal to 75. Taking this example to another level is right here example 2, which says the business buys a $55,000 building with 5,000 cash and a loan, that is mortgage, which is posted as. So asset that is brought into the business is 5,000 and building that is purchased in the business is 50,000, which makes it equal to 55. Correspondingly, there is a loan right here which is liability of 50,000, and this is the owner's capital, that is the cash used for the business, that is 55. Hence it is balanced. So for every debit reaction there is a credit reaction, and for every credit reaction there is a debit reaction. Now when we bring cash into the business, why are we increasing our own liability? Because it's our own cash? No, but because business is always a separate entity. Hence it says right here, business owns nothing and owes nothing. What it owns, it owes. Let's see this example right here, which says Mira has started business by contributing INR 2 lakh as capital, which will increase capital with 2 lakh and cash with 2 lakh. And it goes further that Mira purchases furniture INR rupees 20,000 and 60,000. So the cash left is 1,20,000. Hence 2 lakh is brought in the A side, and this is the cash that is left 1.20, and the furniture and machinery is 80,000. So and the furniture and machinery and cash, so this is 2 equal to 2, hence it is balanced. Let's check another example in which Mira has introduced another cash of rupees 50,000, which will increase our capital side and it will also increase the cash bought in the business. Hence 2,50,000 will equal to 170 plus 20 plus 60. The 50,000 is the extra cash bought in. And that is why a balance sheet is always balanced, because of a dual entry accounting system or a double entry accounting system. That is, for every debit reaction there is a corresponding credit reaction. For every credit reaction there is a equal corresponding debit reaction.